Well, good afternoon, everybody, and again, thank you very much to CS for inviting me to talk to you today. How does the board drive action on ESG? It's a very good question, and what I'd like to do is that I'm going to start my presentation with a bit of a walkthrough of the history of ESG over the past 30 years. I think it's important to understand the why and why this is so important for the board. And it's not something that's just popped up in the last 5 years. Second, I'm going to look at the shifting nature of the value of listed companies and why that has emerged over the years, and why that has changed the conversation in the boardroom, and why that has changed the type of information that goes through to the board as they're making their decisions. I'll then walk through some key takeaways of some recent research that's been undertaken by Brunswick Group, which was about ESG in the investment process, and lastly, look at how to drive ESG in the boardroom through sound governance structures. So first, if we start off with history. So this is a bit of a timeline that starts back in 1989. And I've been really lucky in my career because I've worked in this space starting off in governance in the mid-1990s. And I actually remember that as a time before ESG was even an acronym. And I did sort of hear it being, this term ESG being used in the early 2000s. I said, what's that? And it was environmental, social and governance. And I could never understand why the G was at the end, because I've always looked at how a company manages its exposure to and management of E&S risks through the governance lens and the quality of governance. So I think it's always interesting to look at the timeline of events which have contributed to the increased focus on ESG and have seen ESG move on to the agenda of directors' meetings. The timeline commences in 1989 when we had this massive environmental disaster in Alaska with the Exxon Valdez. This event led to the establishment of the Coalition of Environmentally Responsible Economies, or CERAs, which brings together investors, business leaders, public interest groups to speed up the adoption of sustainable business practices. And CERAs remains today as a very influential organisation. Another incident that happened was in 1991 when social activist Jeff Bollinger published a report detailing the low wages and poor working conditions in Nike's Indonesian factories. The report sparked an outcry and led to boycotts of Nike products. In the first quarter after the report was published, Nike sales fell by 18%. So I feel that this case study shows that externalising costs in order to make shorter-term returns, and in this case by using slave labour, is not sustainable in the longer term. However, Nike was able to weather the storm and sales began to recover in the second quarter, and by 1993 Nike sales had surpassed pre-report levels. So there are several reasons why Nike sales were able to recover. The key one being that the company took steps to improve working conditions in its factories. Nike adopted a code of conduct for its suppliers and began to monitor factories more closely. So this is an example of S that would have come into the boardroom. There would have been decisions about investing in newer factories, in better factories, and reporting systems back to the board to try and avoid the boycotts that had been suffered 2 years earlier. So overall, the impact of the report on Nike sales was relatively minor, and Nike was able to weather the storm and sales rebounded in the longer term. However, the report did have a significant impact on Nike's reputation and led to changes in the way that the company operates. So you can imagine the boardrooms of Nike competitors, at the time, could this happen to us? So those conversations really start around the S side, started to really enter into boardrooms. 1998 saw the Asian financial crisis, and in 1999 the Asian Corporate Governance Association was established to address some of the issues that came at that time, and also CES was established. Both organisations have a purpose to improve the governance of companies in Singapore and Asia more generally. And I'm actually honoured to be a council member of the ACJ, and I've been on that board since 2018. and ACGA undertakes research and advocacy work on behalf of its clients or members, which are global institutional investors, on governance issues, on regulatory advocacy, and also social and environmental issues. So early on in this century, 2001, 2002, we saw collapses of two major companies in the US, Enron and WorldCom. An investor questioned the boards, what the boards were doing, and how they failed in their oversight function. And the failure of these two companies saw significant regulatory changes in the US, particularly in the area of audit. The competence, skills and experience of board directors were clearly under the microscope at this stage. That it brought in a very big focus on the G. In 2001, Singapore introduced a corporate governance code, with Hong Kong following in 2005. Directors now had to sign off on a report detailing how the board discharged its oversight duty on behalf of shareholders. Another milestone that has pushed ESG into boardrooms was the establishment of the United Nations Principles of Responsible Investment in 2006. The PRI is an enormous and very influential organisation today, and its members represent over $120 trillion under management. So investor signatories, the owners or the investors in listed companies, commit to 6 principles: to incorporate ESG issues into the investment analysis and decision-making process, be active owners and incorporate ESG into the ownership policies and practices, seek appropriate disclosure of ESG issues by the entities in which they invest, promote acceptance and implementation of the principles within the investment industry, work with other investors to enhance effectiveness in implementing the principles, and number 6 is report on activities and progress towards implementing the principles. So the establishment of the PRI saw the beginning of the rise of investor focus on E&S in the ESG equation, and investors wanting to see public disclosures explaining how a company identified material E&S risks, what they were exposed to, and how those risks were managed. From the manufacturing area, looking at a Nike, where are the risks in your supply chain? So despite the focus by investors in ESG, which led its way to the boardroom, 2008 saw the global financial crisis, or the GFC. So the GFC saw criticism of both boards and investors. Boards because of a lack of oversight, and investors for being asleep at the wheel and failing in their own stewardship responsibilities. So there was also an issue of information disclosure by listed companies that failed to alert investors of what was really happening. So to address this issue, in 2010, the International Integrated Reporting Council was established, and it's to develop a globally accepted framework for a process that results in communications by an organisation about value creation over time. And so the IIRC is now effectively part of the International Sustainability Standards Boards, for those who have been watching that, the progress of the convergence of sustainability reporting. So due to the criticism of investors regarding the GFC, the UK introduced a stewardship code in 2012. And the aim of the code was to enhance the quality of engagement between companies and institutional investors, so to help improve long-term returns for shareholders and provide for efficient exercise of governance responsibilities. Since the UK established a stewardship code, similar codes have been introduced, particularly in Asia, in Malaysia, Japan, Taiwan, and, as you know, Singapore. The issue of engagement with of listed companies with institutional investors has evolved quite significantly over the last 20 years. In Australia, where I'm doing most of my work now, it's quite common for the chairman of an ASX 100 company to meet with major institutional shareholders on an annual basis, particularly before the AGM, to discuss things such as the election of directors, remuneration, because Australia has a say on pay regime, on succession planning, and also environmental and social issues, and in particular at the moment, climate change and Indigenous rights. Such engagement is still, from my observations, maturing in Asia, and that's because of the existence of block shareholders, family and state. And institutional investors just don't have the power that they have, particularly around voting, when there's a block shareholder of, say, 40+%. So what I have hoped I've demonstrated just by looking at this timeline is that ESG has not just popped up in the last 5 or 10 years. It's been around a long time. And these issues have been evolving since the 1980s and more likely be even before that, and will continue to evolve as they go to the core of value creation or destruction. So now I'm just going to move to my next slide, which is some research undertaken by a firm called Ocean Tomo. And this shows that in 1975, 83% of the market cap of S&P 500 companies was represented by tangible assets, with 17% by intangible assets. Now, as you can see, they've replicated this research. The last one was released in 2020, and it's completely reversed, or more than reversed, that you have 90% of the value of the market cap is represented by intangible assets, with only 10% by tangible assets. And tangible assets are the financial and manufactured assets. So what makes up this 90%? And remembering that the board are stewards of the company's assets, so they've got to be on top of what makes up this 90%. Now, there are 4 capitals which I will refer to, and the percentage of contribution to that intangible aspect will differ depending on the type of company. But human capital is a key one. You know, today we're operating in a talent-constrained world, and those companies that can attract and retain good talent, amongst other things, will lead to greater productivity, lower costs, higher revenue and lower costs, and more sustainable returns for shareholders. Social capital. It's so important to have buy-in from local communities, and it's essential for maintaining social licence to operate. Environmental capital. Businesses today are operating in a resource-constrained world. Minimising the impact of the environment while at the same time preserving resources leads to a stronger social licence to operate, lower costs and lower exposure or impact of regulatory changes. Intellectual capital, which relates directly to the session that we saw beforehand. So we've seen a transition from manufacturing-based to a knowledge-based economy, and this has significantly increased the value of intellectual capital in corporate value creation processes. Those organisations that recognise and invest in intellectual capital will be better prepared for rapidly changing technologies that cause disruption to business and be better positioned to take advantage of new technologies. And for some companies, and you think of the world's largest companies like the Apples, the Facebooks, the Googles, etc., you know, the intellectual capital side of things is probably close to 90%. So it's actually interesting when you look at this, the significant increase in intangibles from 1985 to 1995, and the research hasn't explained it, but I can't help but think that's when the internet really sort of came into its own and has really impacted the operations of companies, and that shift from the to the electronic age, if you like. So, as I said before, the board of directors is a steward of the assets of the companies, and those assets include intangible assets, which are in most cases now more important for value creation than tangible assets. Now, I sometimes use the term ESG, sustainability, and non-financial. When I'm referring to issues, I use those terms interchangeably, but I do want to emphasise that just because an issue is non-financial doesn't mean that it can have financial impact, either positive or negative, depend on the way it's managed, if it's a risk, or how a company benefits from the opportunities. To discharge their stewardship function, the board needs relevant information that is related to value. Board packs today should contain relevant financial information to keep the board informed, non-financial data to keep the board informed on those intangible assets. And this is a significant change, and I really would, if I could get access, have a look at some of the board agendas from, say, back in 1975, and the difference in what's on the agenda, I think, would be absolutely profound. One of the terms that we do use in Brunswick when we're talking to boards and some of the issues that they face is issues congestion. When you think of cyber, you think of AI, you think of digital disruption, of all those things from a non-financial perspective. It really is sort of an issues overload. Now, the other thing is, when I'm standing here, is that you may think that I am talking about a multi-stakeholder approach. And while I do agree with a multi-stakeholder approach, I'm actually a very strong supporter of shareholder primacy. However, a board cannot deliver sustainable long-term returns for its shareholders without taking that multiple stakeholder approach. And at the end of the day, the board has one master, and that is its shareholders. And that's the lens that should be used by the board. And there'll be lots of people who would disagree with me on that boards should be taking a multi-stakeholder approach. I'm not saying that employees, customers, suppliers are important. They are absolutely important. But at the end of the day, how you look after those stakeholders should be through the lens of an investor. So I'm just going to move to back to investors, in particular active investors, as opposed to index investors. And active investors make buy, hold, sell decisions. Index investors construct a portfolio which is linked to a particular index. We had a client come to us and say, look, we want to attract more ESG investors. How do we do that? Can you help us with our narrative? And I thought about that, and I thought, I know a lot of investors, I'm speaking to investors all the time. I couldn't think of one investor who would make an investment just because a company had good ESG. So we agreed to do some research on behalf of the client and went to both active and index managers, but talking about the active ones first, what drove their investment decision making. And the key findings were that investors focus on and have an appetite for material ESG disclosures, and this is rapidly increasing. That active managers are increasingly hiring ESG specialists to evaluate the ESG performance of the company. But at the end of the day, they're not looking for perfect ESG performance. They're looking for accountability, transparency, and together with continual improvement. And the implications from boards are that they need to understand what investors view as material for their company. And I can't overemphasise the discussions that we had was about material issues, and what it is it's material to cash flow and to future cash flows, which go into their valuation models to determine their valuations. Another finding was that active investors continue to primarily base their investment decisions on the quality of board and management, and that the evaluation of the future financial performance of the company. So they are increasingly taking material ESG factors into account and evaluating potential impact on cash flow. And there is a preference for succinct reporting on all ESG factors and targets and data to demonstrate continual improvement. And one of the big feedback that we got, and I think this is really important for boards, is that they do not read 200-page sustainability reports. They want something, even though you might have that information on the website, they want it summarised into no more than 10 pages. A third finding was that most investors were supportive of the transition to the International Sustainability Standard Board's sustainability-related reporting standards. Climate change policy and climate transition action plans are close to the top of the agenda for most investor stewardship teams and increasingly important for active managers. Most or many investors have signed up to their own climate commitments, which require them to reduce portfolio emissions over time. And investors are increasingly facing pressure from their own clients and beneficiaries, being the pension funds, to demonstrate action on climate change. And again, where it's material. Active managers want to understand the pathways that companies have to achieve stated targets. So for companies that have said net zero by 2050, how are you going to do that? Where is your pathway? What are your short, medium and long-term targets? So the implication for boards in terms of external reporting is to stay abreast of regulatory change to ensure that the company does not become a laggard. We also spoke to index managers, and again, index managers cannot make buy, hold, sell decisions. The questions asked were quite different, and the focus of the interviews was on their own stewardship function. So what we found was that investment stewardship teams are increasingly willing to demonstrate dissatisfaction with poor management of material ESG issues by voting against the company at shareholder meetings. And this could include shareholder proposals, remuneration reports, which is something specific to certain jurisdictions, and the re-election of directors. And in Australia, we are seeing more activity to vote against certain directors when investors feel there's been a lack of accountability by the board. But such actions by investors are limited to jurisdictions. They have limited applicability in jurisdictions such as Singapore because of the block shareholder situation. Another development we're seeing globally and also particularly in Asia is the increase in activism by organisations that attack the credibility of a company due to poor performance on social or environmental issues. Listed companies are being targeted over issues such as human rights, climate change, biodiversity. It's a Singapore-listed company that has a hotel chain, and it also has a mine near the habitat of orangutans, and so the activists were targeting one of their flagship hotels in London. So these types of activism are becoming more and more popular. These organisations are being quite well funded. And the activists can be brutal, and their aim is to cause as much reputational damage as possible. So given the potential impact on value, boards need to be across these issues and ensure that the risks of such actions are being managed in a transparent manner. Taking on activists, taking a negative approach can be fraught with difficulty and can have negative consequences. Many of these social activist organisations are well funded and have the potential to inflict significant reputational harm on a company. There might be a slide behind. The last point I'd like to make is around sustainability governance. We're currently working with a number of clients at the moment who are in the process of reviewing board governance in terms of subcommittees and their charters. And I know this was touched on in the prior session about having a technology subcommittee. I'm very supportive of board subcommittees because they utilise the expertise on the board, but obviously not making any decisions, referring decisions to the board. You don't want to have too many, but where you've got a lot of particular issues that are core to valuation and reputation, committees can be a good idea. So, for example, working with a client at the moment where oil and gas company, significant exposure to climate change. Climate change is now reflected in the skills matrix, so in terms of succession planning and other ESG factors. It's in obviously the Sustainability Committee Charter, because that's one of the key remits of the Sustainability Committee. It's in the Remuneration Committee Charter because the performance-based remuneration has sustainability issues, and which include climate change, and it's in the Audit Charter because climate change has actually been identified as a key audit risk. So it's in there as one of the key risks of the responsibilities of the Audit Committee. An effective governance structure that integrates ESG into board membership and committee charters and membership will ensure that ESG is managed in an effective manner by the board. And I think that's so important, that it's got to be managed effectively, it should be integrated and with the focus on materiality. So in conclusion, Material ESG issues have to be part of the board agenda, and the board should be actively involved in understanding material ESG issues that can impact company performance in the short, medium and long terms. Investor focus and request for more non-financial data will only increase over time, and boards need to consider the appropriate governance framework that's fit for purpose. What specific ESG issues are on the agenda will depend upon the scope of the operations of the company and the materiality of those issues to future performance. So once again, I'd like to say thank you. It's been a pleasure to come back to Singapore after about 3.5 years and to be at this fantastic conference. So thank you very much.